Welcome to the Property Code. I am your host, Nick, and today we unravel one of the most searched questions of 2025, how to start investing in real estate. If the algorithms are any indication, people type variations of that phrase every minute. How to get started in real estate, how to invest with limited savings, how does investing in real estate work, even how to start a real estate business for beginners. The surge in those queries tells us one thing: a new wave of everyday investors is ready to swap scrolling for action. To ground the discussion, meet Laya, a 32-year-old occupational therapist living in Columbus, Ohio. She earns enough to cover student loans and weekend trips, but worried about rising rents and the elusive dream of early retirement. One snowy January evening, she stumbled on a live stream about fractional property platforms, then spent hours comparing returns in real estate to her underperforming index fund. The next morning, she made a promise to herself. By New Year's Eve, she would close on her first rental, even if she had to start small. The first hurdle was clarifying the destination. Laya defined a simple goal: replace 1 week of work income each month through passive rent. That goal answered several high-demand questions in a single stroke: why real estate is the best investment, how much return to expect, and why every plan must link to personal cash flow targets. She opened a spreadsheet and entered 3 assumptions from current market data. Average 2-bedroom apartment rents in her zip code hovered near $1,600 a month. Expenses, taxes, insurance, reserves, and management typically consumed 40% of rent, leaving $960 of free cash before mortgage payments. If she could find a loan with a 6% interest rate and a 20-year amortization, each $100,000 borrowed would cost about $715 a month. Those numbers revealed that a modest $150,000 duplex purchased with 20% down could generate roughly $250 of monthly cash flow after debt service. 4 such units would satisfy her 1-week salary goal. Armed with that clarity, she turned to financing, the second most popular query bucket. Rising mortgage rates in 2025 mean creative capital stacks matter more than ever. Laya discovered a state program offering a 3% down payment assistance loan for first-time buyers willing to house hack, so she shifted her search towards small multifamily properties where she could occupy 1 unit. The program carried income limits, so she stayed below the threshold by paying 2 extra points upfront to secure approval. She also set aside $3,000 for unexpected repairs because the internet is filled with cautionary tales of investors who lose money by ignoring maintenance reserves. Finding inventory proved the next challenge. Listings had fallen during the rate spike, but a backlog of owners who locked in ultra-low loans earlier in the decade were now ready to sell and trade up. Laya filtered for properties on the market at least 30 days, used an AI valuation tool to flag those priced below replacement cost, and drove by each address at dawn and dusk to sense neighborhood rhythms. She learned that data alone cannot replace street feel. One promising quadplex scored high online, yet sat beside an auto salvage yard that roared at sunrise. She walked away, trusting her instincts, an answer to how to start investing step by step. Online research first, boots on pavement second. An early breakthrough came when her agent forwarded a pocket listing for a 2-unit bungalow near a new microbrewery corridor. Asking price was $140,000. She ran a comparative market analysis and estimated after repair value at $160,000 once cosmetic updates were complete. Rents could reach $1,300 per unit within 6 months. She crafted an offer at $134,000 with a seller credit to cover half the closing costs, knowing that in 2025 buyers regain some leverage as days on market lengthen. The seller accepted with a 30-day close. During due diligence, Laya scheduled a general inspection, a sewer scope, and a thermal imaging sweep, all captured in digital reports she stored in the cloud. The sewer revealed a minor root intrusion that would cost $1,500 to fix. She negotiated an equal price reduction rather than risk the timeline. She also confirmed zoning allowed short-term rentals, giving her an exit option if long-term demand softened. That flexibility embodies how to start investing in commercial real estate thinking on a small scale. Always seek multiple income paths. Renovations were light. She painted walls herself, hired a licensed electrician to replace outdated panels, and installed smart thermostats that qualified for a utility rebate covering 30% of cost. She furnished her own unit with second-hand finds and moved in 3 weeks before closing, satisfying owner occupancy rules. Her first tenant arrived in late spring at $1,200 a month. Cash flow landed within $50 of projections, even after property management software fees that automated rent collection and maintenance tickets. Technology shaped every step. She used a fractional share platform to crowdfund $10,000 of her down payment in exchange for a 5% preferred return to friends who lacked time but wanted exposure to property. She relied on a machine learning rent estimator to adjust renewal offers aligned with real-time demand. She signed all documents through blockchain-secured title services, shaving days off traditional escrow. By autumn, her duplex generated $260 of monthly profit, 0.5% above goal. Encouraged, she refinanced into a green loan product at 5.75% after adding attic insulation verified by an energy audit. The lower rate nudged monthly cash flow past $300. Laya diverted that surplus into a self-directed retirement account earmarked for real estate crowdfunding deals, building a loop where property funded more property. What risks did she confront? Vacancy, interest rate resets, and market correction top the list of how does investing in real estate work concerns. She mitigated vacancy by building a 6-month reserve fund and negotiating a clause allowing mid-term corporate leases if traditional tenants dried up. She locked her new mortgage for 20 years, trading the lure of adjustable teaser rates for stability. As for market corrections, historical data shows real estate cycles run longer than equity cycles, but recover slower, so she underwrote conservative appreciation at 3%, not the 5% 10-year average. The experience underscores a blueprint for listeners. Start with a clear cash flow target. Educate yourself on loan programs tailored to first-timers, especially those emphasizing sustainability or community development, since governments in 2025 incentivize green rehabs and affordable stacking. Harness AI to analyze neighborhoods but ground truth every street. Negotiate strategically using longer days on market to request seller credits or buy-down points. Embrace technology for remote signatures, automated bookkeeping, and fractional funding that lowers barriers, and never skip reserves. Even a properly screened tenant can lose a job or a water heater can burst at dawn. Remember too that starting does not require buying. You can dip a toe through real estate investment trust in your retirement account, invest in Regulation A crowdfunding offerings, or partner in a joint venture. The key is to move from theory to practice with disciplined math and abundant caution. As Laya proved, one small duplex can launch a new identity. By December, she no longer introduced herself as an occupational therapist first, but as a real estate investor with 2 doors and a rising net worth. Thank you for tuning in to The Property Code. If this episode clarified how to start investing in real estate, share it with a friend typing that same question into a search bar tonight. Subscribe, leave a review. Until next time, stay strategic and keep building your financial future.